Right now, most people believe they're witnessing an energy meltdown in real time. And on the surface, that fear looks completely justified. Energy markets are swinging wildly. Governments from Berlin to Tokyo are calling urgent summits, and everyone's pointing fingers at one location. The Strait of Hormuz, a narrow waterway that serves as the only maritime exit from the Persian Gulf. Every single day, nearly one-fifth of the planet's crude oil flows through that channel, making it the most critical bottleneck on Earth. The common wisdom is brutally simple. If anything jams this passage, the global economy grinds to a halt. But maybe that's only the surface story. What looks like a crisis might just be a repositioning. Because the deeper truth isn't about what's breaking, it's about who gets hit and who quietly profits. Oil shocks have never been democratic. Some nations get flattened, others ride the wave. That's the real narrative here, not a disaster, but a shift in leverage. Most people still assume this will play out like it did 2 decades ago. Instability in the Persian Gulf sparks an oil spike, and that spike eventually crushes the American economy. For years, that was accurate. 20 years back, the US relied on foreign oil for about 60% of its total use. So when global supply hiccuped, prices rocketed, inflation roared, and growth stalled. A straight line from disruption to pain, but that world is gone. Over the last 20 years, something fundamental shifted. Fracking and new drilling methods unlocked vast shale fields across North America. Production exploded, and America didn't just cut its foreign dependency, it reversed the entire equation. Fast forward to today. The United States is now the globe's top oil producer, which means the old story is obsolete, because now America sits on the opposite side of the trade. So the real question becomes, who is actually vulnerable? Have you ever wondered why headlines scream global crisis, but some stock portfolios are quietly booming? Here's where the answer hides. Most of the crude moving through the Strait of Hormuz isn't destined for the US. In fact, only about 2 to 12% of it lands on American shores. The vast majority heads east to Asia, specifically to China, India, Japan, and South Korea. Together, those 4 nations account for roughly 3/4 of all the oil transiting that narrow strait. So when experts warn that a blockage would shock the world, they aren't wrong. But they're skipping a crucial detail. It's an asymmetric shock. It doesn't bruise everyone the same way. For the United States, a disruption mostly becomes a price headache. Oil trades on a global market, so if supply tightens anywhere, prices rise everywhere. That stings, but it's survivable. For Asia, it's a whole different beast. It's not just a price problem, it becomes a physical supply problem. Higher prices slow you down, but losing actual access to energy, that's when systems start cracking. Factories idle, fuel rationing begins, production lines freeze. Same event, radically different outcomes. This is where the story pivots from catastrophe to positioning. Scarcity doesn't just destroy value, it redistributes it. When supply squeezes and prices climb, winners and losers emerge. Right now, the United States sits squarely in the winners column, because higher prices aren't merely a cost, they're revenue for producers, exporters, and energy firms. And America happens to be the world's largest oil producer. So the very same shock that inflicts pain elsewhere also pumps money into parts of the US economy. But crude oil is only half the picture. What if the real leverage comes from something most people never even think about? Natural gas. The Middle East is also a giant exporter of liquefied natural gas. And like oil, a massive chunk of that gas travels through the Strait of Hormuz, about 20% of the global LNG supply. Countries such as Qatar and the UAE send over 90% of their LNG exports through that same passage. So if the strait gets blocked, gas markets tighten right alongside oil markets. And once again, the United States steps onto the stage. Over the past decade, America has quietly become the world's largest LNG exporter. Same pattern repeats. One region loses supply, another steps in to sell. Markets are already sniffing this out. Venture Global, a fast-rising LNG player, has seen its stock jump nearly 40% in the last month. Cheniere Energy, the biggest US LNG exporter, is up about 15%. On the crude side, similar moves are playing out, because scarcity doesn't just create risk, it manufactures opportunity. And speaking of bottlenecks, they aren't limited to energy markets. They exist in technology too. Right now, we don't have a shortage of AI tools. We have the opposite mess: too many models, too many options, and no clear answer on which one you should actually use. That brings us to today's sponsor, Abacus AI. What they've built is a way around this confusion. When you go to Abacus AI, you get access to all the top AI models in one dashboard. Think ChatGPT 5.4, Gemini 3.1 Pro, Claude Opus 4.6. Instead of jumping between tabs and guessing which model works best, you can use their Root LLM feature. It automatically picks the ideal model based on your prompt, and it's not just text. You can generate images, videos, even full presentations. There's also the Deep Agent, which builds apps, websites, software, and more. Best part, all of this costs only $10 a month, far cheaper than paying for each tool separately. If you're interested, check out Abacus using the link below or in the pinned comment. Thanks to Abacus AI for sponsoring this video. Now back to oil. If a disruption in the Strait of Hormuz is quietly handing the United States leverage in global commerce, then the obvious next question is, who loses the most? The answer is China, but here's where it gets layered. Beijing saw this threat coming years ago. They've spent a fortune diversifying suppliers, stockpiling strategic reserves, and ramping up imports from alternative sources like Russia, Brazil, and Venezuela. Yet despite all those hedges, China hasn't erased the risk. They've only bought time, because China is the world's largest oil importer. They burn about 15 to 16 million barrels per day, and roughly 11 million of those barrels come from abroad. A huge slice of that originates in the Middle East, flowing directly through the Strait of Hormuz, which means their safeguards don't eliminate the vulnerability, they just postpone it. In the short run, China can probably absorb a shock. In the medium run, they start draining reserves. But if the disruption drags on long enough, that's when the real fracture appears. The problem shifts from an inconvenience to a structural breakdown, because China doesn't merely use energy, it runs on it. From manufacturing to exports to industrial output, the engine of China's economy depends on a constant, uninterrupted energy flow. And when that flow is severed, pressure mounts. Have you noticed how few people are asking about the timing? That brings us to the part of this story almost no one is discussing. Step back for a second. Something about this whole situation feels off. Not the conflict itself, those happen constantly in the Middle East. It's the timing. Right as tensions around the Strait of Hormuz began escalating, something else was reaching a boiling point. Trade negotiations between the United States and China were hitting a critical juncture. Tariffs, technology bans, supply chain decoupling. For years, the economic and political bond between the world's two largest economies has been slowly tearing apart. And maybe that's where the real truth of this crisis lies, because perhaps those negotiations aren't really about finding a solution. Maybe they're about leverage. And if that's the case, leverage flows from pressure. Economic pressure, market pressure, and sometimes energy pressure. When you view the entire situation through that lens, the Strait of Hormuz stops looking like an energy story and starts looking like a geopolitical chess match between Beijing and Washington. Because if one country can endure the shock while the other feels structural pain, then the shock itself becomes a bargaining chip. A choke point for oil is also a choke point for power, which means maybe the Strait of Hormuz isn't just a bottleneck for crude, it's a bottleneck for influence itself.